Hey everyone, welcome to another episode of the Back Channel. In today's episode, I want to do a little bit of clarifying around a very specific element of fundraising that I think a lot of founders reference, they work within, but don't deeply understand how it actually works. And that topic is valuation caps. A valuation cap is thrown around. What did you raise your last round on? What did you use? You used a safe. What was the valuation cap? And while I think people's understanding of valuation caps are probably greater than 50% accurate, I don't feel like they're even close to the 80, 90, or even 100% mark of deep understanding. So I'd like to get into that. I'd like to make sure that everyone listening after this episode has a much stronger understanding of what it is, how it works, and how you need to work with it to prepare for your fundraise. Okay, so valuation caps. Let's take a few steps back and just say, what are valuation caps all about? What do they apply to? A valuation cap is an element of a fundraising vehicle. In today's day and age, we are mostly using safes, but valuation caps were also relevant in the world of convertible notes. Now, those two things, convertible notes and safes, are a vehicle to invest in a company that allows an investor to put money into a company without going through the definitive document stage of creating new equity in a company. The quick and dirty summary of that is it takes a lot more time and effort and legal documents in order to do a formal equity investment where an investor holds shares in a company. And when people were coming up with things like convertible notes and safes, the idea was to create a structure that would allow a founder to raise capital much more quickly, get money into the company, and get back to work. Now, because a convertible note and a safe are not actual equity investments, the investor doesn't own shares in the company. And so they don't have a specific piece of paper that says, here's the shares of the company that you own. Instead, it's a simple agreement for future equity. That's what a safe is. The agreement creates guidelines around how the dollars that they put into the company will convert into equity in the future. Now, that future point in time is the future equity round. So when the company goes out to raise another round of capital, when they finally decide to do a much more formal fundraise where they get equity investors in, that engagement will create all the legal documents necessary to bring on new equity shareholders, and people that own the safe investment will then convert into equity. Okay, so that's a long background around where safes come in. And so where does the valuation cap come in? Well, it's there to dictate how your investment will convert and at what terms and at what price when this conversion event happens, when this future fundraise into an equity round actually happens. So with valuation caps, and we'll say for a safe investment, what we are putting out there, and let's hypothetically say you are investing $1 million into a $10 million post-money valuation cap safe, okay? A $10 million valuation cap. What that is saying is that when the company goes out and raises their next equity round of investment, if the valuation that they raise that equity round out is higher than $10 million, then the holders of this safe at a $10 million valuation cap get to convert their investment $10 million. So assuming that the company has 10 million shares outstanding and the valuation cap is $10 million, well, then that's a dollar price per share conversion rate. And your $1 million of investment into that valuation, into that safe with a $10 million valuation cap will buy you 1 million additional shares. Like many of you, my last venture-backed startup was a SaaS business. In that company early on, we had the opportunity to sell into a large enterprise, but ran into some walls when they asked us if we were SOC 2 certified. Not only were we not certified, we also found out that it would take our small team a ton of time to get that done, and so we ended up abandoning the deal. If you haven't run into a situation like that where a potential customer or investor is asking if you're SOC 2, HIPAA, GDPR, or ISO 27001 certified, you probably will soon. But unlike me, you could use a company called Vanta to help. Vanta helps automate up to 90% of the compliance work, getting you audit ready in weeks rather than months, and eliminating up to 85% of the costs. Not only that, but Vanta can start small with you and scale up as you grow, helping you land bigger deals and earn customer trust. The best part is, Vanta is offering funded listeners $1,000 off for going to vanta.com/funded. That's VANTA.com/funded for $1,000 off your service. Check it out. Now, some of you, I'm sure, are screaming, whoa, what about pre-money cap versus post-money cap? And that's a very good question. The scenario that I ran you through was for a pre-money cap safe, as in, what is the valuation that we're calculating the price per share before money gets invested into the company? So a $10 million pre-money valuation cap will yield the math that I just described, which is, okay, the 10 million outstanding shares is valued at $10 million. So $10 million divided by 10 million shares equals $1 price per share. Then the $1 million of investment get added into the company. After the safe conversion, that's a $11 million valued company. What about a post-money cap safe? Now, post-money cap safes are more of the standard that's used today with safes. So most safe investments that you see today are going to be post-money cap safes. Now, how does that work? So the post-money valuation cap says, all of the money that's converting in to the company gets added into the valuation of the company in order to create that post-money. So after that money goes in valuation cap. So if we use the same numbers, a $10 million post-money valuation cap, investing $1 million, what that's actually saying is the company is worth $9 million today, because $9 million plus $1 million of money in would equal a $10 million post-money valuation cap. So in order to determine the price per share that you're calculating the conversion at, you take the $9 million valuation today divided by the 10 million of outstanding shares, meaning each share would be 90 cents, and $1 million would buy something like 1.1 million shares because the shares only cost 90 cents. Okay. So that is the first topic that I want to cover in the overall topic of valuation caps and safes. I don't want to go too deep because this has already been a complex enough back channel episode. What I'd love for you to do is re-listen to this, take a pen and paper, write some of this stuff down so you can understand the dynamics. But at the end of the day, the valuation cap is there to help you convert your shares into equity when that converting event happens in the future. Now, there's a scenario in which the valuation cap doesn't actually come into play. And that is if the future equity round that gets raised happens at a price or a valuation that's lower than the valuation cap. So in the same scenario, the same example, we had invested $1 million in a, call it $10 million post-money valuation cap safe. If a company then goes out and raises an equity round at $8 million, well, then your dollars just convert at that price and not the $10 million valuation cap because it didn't meet the cap. And that's why it's called a cap. That's the high end of the valuations that you'll ever convert at. Okay. There's a bit of complicated math, some different dynamics, but it's good for you to deeply understand the mechanics of investing and fundraising so that when you go into your own fundraise, you have a clearer sense of what you're asking for. You have a clear sense of what the investors are asking of you, and you'll be able to navigate the waters much more clearly. All right. I hope this has been an educational and helpful episode of the Back Channel. Let us know if there are other topics that you want me to break down, and I'll see you next time.